If the gap is to eventually be completely filled, there will have to be a downswing around the 25.53 level or the declined double tops downtrend lines. The gap up range and gap fill level are proven to be valid as they clearly align with swing points in a major high range prior to the broad stock market decline during the global recession of 2008. Interestingly, the current downswing lines up with a triple top range that failed. This is because supporting influence from the lower boundary extension to the gap up candle's close of 25.53. That decision was made since 25.53 was a major short-term support likely to oppose the drop from the narrower triple top range. A gap up begins a bullish break over expected resistance into August. The incline is so bullish it still passes the double top resistance after relatively flat short-term trading before peaking in mid-August. The current downtrend is a natural correction after such a steep incline. Naturally, the old 25.53 area now marks the approximate gap fill area. Here is a case where a descending trend line intersects with support levels to form areas of increased support potential. It leads to the eventual reversal in December where there is the more familiar sight of stronger resistance potential from descending trend lines intersecting with resistance levels. It turns out the break of the downward channel was part of the gradual transition summarized by the neatly contained price action within a reverse head and shoulders. It conveniently reused old ranges that marked the head, neckline, and shoulder levels. It was certainly a classic bullish break over the neckline, leading to a relatively short but aggressive uptrend. The gap down fill range in the 37s demonstrates bullish strength after normal resistance upon first filling in the gap. At first, price is held down, but adequate bullish volume moves the chart to new highs in early May 2013. When there is a moderate correction, the 37 range promptly reverses roles for solid long-term support to sustain the larger uptrend. A later peak and gap downfill finds strong support in the form of a spread-out triple bottom range, which overlaps with a wider gap down range. The pair of uptrend lines has been lowered to accommodate the new upswing. The gap downfill leads to a regular downward reversal. Similar to other examples, there are qualities of a declined double top, but the downswings aren't too closely aligned, and the decline is too steep. It is closer to a regular downtrend with declined double top features. A head and shoulders reversal begins but is quickly halted, as a series of bull hammers prevents a decisive downtrend. However, bearish sentiment remains strong after the relatively weak bullish continuation. This is shown by the disparity of small green candles and low green volume to large red candles and high red volume. The two large red candles and the bearish engulfing could be considered a compact triple top variant. As the chart recovers, the uptrend lines are adjusted again to account for the newest upswing after the steep correction broke through the old arrangement. After the head and shoulders completed to start 2015 with a gap down, there is more opposition to a further drop, as that would lead to bearish overextension in the short term. And trading is also in close proximity to the adjusted long-term uptrend lines. The neckline range is expanded to factor in the heavier resistance in the lower 60s from the upswings just before and after the Head and Shoulders, along with residual bearish influence from the earlier compact triple top. The expanded neckline range also expands the gap down fill range by default. A look back at just closing prices reveals clear price action in the Head and Shoulders and overall neat containment under the bearish influence of the downtrend lines. April to May demonstrates a case where broken long-term uptrend lines and the gap down fill range in the 50s intersect to present stronger resistance potential. This helps sustain bearish influence from the Head and Shoulders gap down fill combination. Adjusting the upper downtrend line to accommodate the May downswing proves to be helpful, as a series of downswings form under its influence in August and September. Additional validity to the adjusted long-term downtrend line is seen when a double bottom reversal is quickly reversed in mid-October. Bearish context is strong with the familiar feature of a gap down that is not immediately filled. This is taken further as the gap down range presents a clear decline. For a clean descending triangle, it sustains a move that would have otherwise been a bearish overextension. The smaller descending triangle outline is the more theoretically correct outline, and the larger triangle outline is more a representation of the downward slope of the gap down range. The chart continues to show a classic case of a strong long-term downtrend that doesn't become bearishly overextended for too long. There are adequate bullish retracements and plenty of selling volume, periodic spikes to sustain the decisive gap down and descending triangle combination. Therefore, prolonged resistance in the 37s is very normal when there is a sustained recovery. As a sustained uptrend progresses, many of the old ranges prove to retain precise influence, as many swing points and patterns, including gaps, form with many closing prices around them.